Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So, World Bank basically came out and said that, hey, 2023 is going to be all good. This year there's not going to be any sort of recession or hard landing. 2024 we might see some hiccups there, but all is good, all is well. The coast is clear. Now, is that true? Is it true that everything's fine? Growth is much better than expected. Well, let's take a look at some of the productivity and the imports and exports numbers when we look at trade data and see how certain countries are doing when it comes to their productivity and selling their goods and services. Let's start with China, right? China was one of those countries where everybody out there was saying that as soon as China comes out of their COVID pandemic and out of their lockdowns, you're going to see massive growth in the economy worldwide. They're going to go around, shop around, throw this money left and right, and growth is going to be fine, and all the countries are going to be fine, and we're going to be out of this little hiccup that we're feeling right now. Well, when you look at Chinese export numbers year over year, the number comes in at negative 7.5% versus the forecast of minus 0.4%, and also versus the previous number that was positive 8.5%. Basically telling you that China is not exporting as much as people would think they would, and is actually slowing down on giving out and selling their goods. Because what? Because there is an issue within their own economy as well, which is holding them back on selling these goods and services. Hence why the whole situation of the inflation continues to also be a problem, and why it continues to be sticky, because as we have seen previously before the whole COVID pandemic, the world, the West, was very dependent on just-in-time delivery, very dependent on getting cheap products very fast, and that has completely shifted and changed since the pandemic, and since with all of this issues between the West and the East. And you're seeing it here still in the Chinese export data here. You're still seeing, you're seeing a negative number, which is they're slowing down the exports. They're feeling that their economy is going through some turbulence there, and is actually not pairing up with everybody's expectation that they're going to be the savior of this whole economy, and they're going to push demand and growth, which is not happening right now. So makes you think, what is World Bank seeing that we're not seeing, or are they completely off when it comes to their analysis on the growth this year? Because we see a different story when we look at these numbers in China. Now let's look at the import numbers here for China. The import numbers are also in negative territory, however better than the forecast. Forecast was for -8, and the previous number was -7.9, but the number comes in at -4.5%. So still in negative territory, still not so good. So yes, they are importing less, and again, exporting also less, but that's still showing you a sign that there is a growth problem there. Let's also look at Germany, right? Germany is supposed to be that powerhouse for Europe, right? Germany's yield curve is in massive inverted levels, right? It's signaling recession. Germany's having an issue with their labor market also. Right? They're trying to bring in more immigrants, but as the demographics change, and as more baby boomers decide to retire, there are less and less workers to find, which is also elevating, keeping inflation sticky and high up there. So when you look at the import side of things, Germany's import month-over-month number comes in at -1.7% versus the forecast of -1%, worse than expected, basically telling you less goods are coming into the country. And if you've got got less goods coming into the country and you've got some labor issues happening. That's keeping inflation high up there, keeping the ECB, European Central Bank, continuing to tighten. That's why you're hearing all of these central banks worldwide synchronize together, tightening, 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 rates, 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 QT, 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 because hey, you know, yes, there's an issue with importing things here. Yes, there's a labor issue as well, but that's causing also inflation to be quite elevated, and you know, it's a problem that they need to deal with, which is not looking good for Europe's biggest engine, which is Germany. Now, when you look at the export side of things, month over month, better than expected, coming out plus 1.2% versus the forecast of minus 2.5%. So you could argue there that yes, they are slightly doing better here when it comes to exporting goods, bringing some revenue into the country. However, it is not as good as the previous numbers back then. That was of this year in April, which were numbers at plus 4%. Now moving on, let's look at the US numbers, right? The US export numbers, the actual numbers are around 249 billion. The previous was 258 billion. When you look at the chart, it is slightly slanting lower and lower. So you are also seeing the effects of US exports come down and down because there's less interest, less demand. Again, the story that I'm trying to convey here from telling you these numbers is that the demand side of things are slowing. It's crunching up, right? You're seeing less sales there, less exports going out, right? And on the import side of things for US, it's around 323 billion versus the previous number of 318 billion, slightly higher. But then when you look at the graph again, its highest point was last year, which was around 351, and you're seeing the graph come down where also imports are slowing down. So again, when you have the imports and exports, so you're selling less, you're bringing in less, there's a demand issue, and not only you've got a demand issue, you also have a labor issue as well, where you know certain things, certain supply chains are not as efficient as they were, which is keeping that sticky inflation high up there. And it goes back to also the bullwhip effect, right? The whole effect that happened when there was an inflow of money and people and the central banks were going out and pumping money in the system, and then we were in lockdown, and a lot of companies out there were ordering goods because of what they've experienced, right? They sold a lot of their goods because people had a lot of money, so they imported a lot of goods, and those goods came in at the wrong time because that's when things started to really slow down and people didn't need as many items like they did during the COVID time. And now they have all these goods sitting on the shelf, which they have to get off and they have to sell. And if that's the issue, that means they will be importing less, bringing in less. And if they're importing and bringing in less, you're seeing in the stores, and even when I go to my local store, you might see it as well, that if you want a certain item, you now have to either order it online or request it there, and they're going to order it online, have it shipped to them, and bring it in. There's no more the idea of that, hey, it's going to be on our shelves now and you can pick it up. Completely shift here in the way how supply chain and the way how COVID disrupted the supply chain, and you can see that with the imports number in the US coming down, this doesn't make the situation with inflation better off. Yes, there's also a story here when you look at the exports as well and the imports showing that the demand crunch, right? But also with the slowdown in growth and demand, you're still getting sticky inflation. You're still getting the high inflation because of the issues with all the supply chain and everything that I just explained. Now, going forward again here, take a look at this. Canada's labor productivity quarter over quarter report, that number came in at minus 0.6% versus the forecast of 0.2%, and Canada just increased their interest rates also because of the higher inflation. But you're seeing the labor productivity. Now here's the thing, right? Canada is importing and bringing in a lot of immigrants into the country, right? But the efficiency, right? Same issue that Germany is facing. They're trying to bring in more people into the countries, but the efficiency is not there, right? Because the skilled labor is not there. And to get skilled labor, it's probably taking time for them because they need to be educated in different areas, going to school, etc., right? So that's going to take some sort of time, some lag effect. And if that's the case, you're bringing these people into the country, there's a lot of people there. There's enough jobs there, but not enough skilled people, and the productivity numbers are negative and not looking good. That is not a good sign when it comes to the inflation metrics, right? Not a good sign when it comes to the growth metrics. So you're having weak growth, but inflation's still high up there. So the productivity numbers in Canada have been negative for 6 months, aside for 1 month, which is an outlier that was positive 0.1%. But other than that month, 6 months have been negative, which is not a good sign. Again, a sign of weakness in the economy and sign of this inflation being an issue, which leads to that disastrous moment, which I've been talking about, that, hey, you got a weak economy. Yes, the economy is weaker, but the Fed or the central bank or the Bank of Canada, whoever it is, right, continues to hike because they've got a mission to bring inflation down. Now, what about Australia? Right, Australia's number also are not looking so good. Now the imports number are about plus 2%, which is below the previous number of 4%. But take a look at the exports number, which is negative 5% versus the previous number of plus 4%. So Australia's also feeling the pain and the pinch. They're having issues also with inflation, just like the story in almost every country. So what is World Bank saying about that growth is better? Why are people saying that there's a soft landing coming and things are fine and growth is going to pick up and it's not as bad as before? You might hear arguments that, hey, we had negative GDP, 2 consecutive numbers last year, and now we're not seeing the same thing, so everything's fine. I disagree with all of that. You're seeing the weakness in the exports number, the imports numbers, the productivity numbers. These numbers are also lagging, and these numbers take time to reflect the real situation. And a recession is not an event. It doesn't happen in one day. There's not this one kaboom moment. It happens over time, and then you get the kaboom moment. That kaboom moment may be coming soon, maybe in a year, maybe 6 months. I don't know, but it looks like it's coming slower and slower, especially when you see the weakness, not in just one country, but globally out there as well. And as this weakness continues, you have central banks that continue to fight and fight and tighten and tighten. And in history, where does this all go to? Well, in history, it shows us that these central banks continue to tighten until something breaks. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.